Hi everyone, welcome to Vault's official YouTube channel. So on today's video, we are going to understand the difference between yield farming, staking and liquidity pooling. These are fairly important DeFi concepts, and if you want to kickstart your journey in DeFi and understand whether or not you should be doing yield farming and making crazy amounts of money, you should watch this video very carefully. So just to share a very quick anecdote that I myself have been doing yield farming for close to a year now, and the yields have been fairly high. If I would have gone and deposited my money in a traditional bank, I would have made a rate of interest sitting in India roughly between like 2 to 3% on my savings account. And if I would have done a fixed deposit, I would have probably made 5 to 6%. But in the crypto/yield farming world, I can make returns up to 108% APY also. And there are people who make even better returns. But I don't want to showcase just one part of the story, which is rosy, which is prominent, which is very promising. I would also talk about the risk profile. So we will do that complete study on this video. So let us get the video started. And first and foremost, let us understand the key difference between staking and liquidity pooling. It sounds complicated, but I will simplify this for you. Now, staking is a very broad word and it can be used in multiple contexts. For example, you would have seen that VCs or angel investors, they invest in a particular startup. So whenever they invest in a particular startup, they get certain amount of equity in return. And what is it said that what do they own in that company? They own a particular stake, which is in form of an equity. So it would look something like this, that if you are talking about the traditional business world, and if this is considered to be a company, then a VC or an angel investor, if they are owning a certain percentage of the company, then it is said that they own a stake in that particular company. Now, what is the advantage of owning this stake? That of course you will get certain amount of return if the business does well. Also, you would support that business in terms of growth. Why? Because since you're an equity holder in that company, your fortunes are somewhat tied to that company's growth. So of course, you as an angel investor or VC would try to provide support to that particular company. Why? Because you own a stake. So a similar concept is applied in the crypto world where you end up staking your cryptos. Now, what does staking your crypto means? Here is a video that I had done on the difference between proof of work and proof of stake blockchain. Please go and revisit that video. It's a fairly important video. And on that video, I spoke about a very important concept called as proof of stake consensus mechanism. So consensus mechanism simply means that if you look at any blockchain network, be it Cardano, Solana, Bitcoin, Ethereum, then whatever data is being put on that blockchain, it needs to be verified or validated. Now, certain blockchains, for example, Cardano, they work on proof of stake concept. In proof of stake, what happens is that you become a validator. Validator simply means a person who is validating whether the data is correct or not, and if it should be put on the blockchain network. You become a validator only and only if you have a certain stake in Cardano. So first and foremost, in order to become a validator on Cardano, you need to have certain ADA coins. Similarly, there are many other blockchain networks which work on proof of stake consensus mechanism or proof of stake verification. And there, in order to become a validator, you need to own a certain equity or certain number of coins to become those validators. So the obvious question here would be that, hey, what is the benefit of me becoming a validator? You end up getting rewards every time a verification is done via your end. So that is the benefit, and that is the reason why people become validators on proof of stake consensus mechanism. Another key aspect of staking is that sometimes people just simply go and stake their coins. For example, if you have a bunch of Bitcoin, a bunch of Ethereum, and 100 other different cryptos, you're a crypto millionaire. So you will go and stake your coins in certain liquidity pools. Now, what are liquidity pools? Imagine liquidity pool to be like your bank account. So when you go to a bank account and if you give your bank $100, what is it that the bank will do? The bank will take this $100 and it will lend out to other people. And in return, they will be making a commission, maybe 2%, 3%, etc. And this is how a bank would operate. So liquidity pools also work quite similarly, that if you have $100 worth of Bitcoin, you would go and give it to a crypto bank, so to say. It could be protocols like Aave or Compound. When you give this $100, Aave will pick it up and it will lend it out further to people who need those cryptos. And in return, Aave will make a certain commission and they will pass on that commission to you. So that is what broadly a liquidity pool is. So coming back to staking, it has two primary utilities. One is that you can stake your cryptos and become a validator validator on certain blockchains. And second is that you can stake your crypto coins on these digital banks like Aave, Compound, etc. And in return, you will be making a certain yield or rate of interest. So this brings us to two additional concepts on DeFi, which is liquidity pooling and who are liquidity providers. So let's start with liquidity providers. So liquidity providers in very easy to understand way would mean people who want to provide liquidity, they become LPs or liquidity providers. Now what exactly is liquidity pooling? So liquidity pooling is a slightly more advanced version of staking. So staking is very broad. It has two primary functionalities. One is for validation purpose. You can stake your coins on a blockchain network. And second is that you can stake your coins in order to make returns. So that process is called as liquidity pooling. And there are a lot of protocols where liquidity providers can give their money to these liquidity pools. So this process is called as liquidity pooling, and liquidity pooling is primarily done in order to make certain yield or certain returns from that liquidity pool. Now, even the liquidity pools are of two types. The first type is called as a centralized finance, and the second type is called as decentralized finance based liquidity pools. So let us go through it one by one. Centralized finance could be an exchange based liquidity pool. A classic case in point is Vauld. So on Vauld, if you go and you are purchasing your cryptocurrencies, you get an option of doing a fixed deposit on that currency. For example, if you buy Bitcoin on Vauld, then you go and do a fixed deposit on Vauld, you will get roughly a 6.7% APY on Bitcoin. Similarly, if you are doing your fixed deposit on USDC or USDT, then the amount of returns go up. So it depends from coin to coin. But the point that I want to drive home is that protocols like Vauld are CeFi liquidity pools where you can stake your money in order to make certain returns. The second category here is DeFi protocols. For example, there are protocols like PancakeSwap, SushiSwap, Compound, Aave. So you can go and stake your money even there, and there also you will be making a certain return. So now comes the natural question that are DeFi protocols better or are CeFi protocols better? So honestly, there is no one right answer here. It depends according to me on 5 key factors. So first and foremost is how comfortable you are in the DeFi protocol ecosystem. If you're not comfortable with DeFi and if you don't know and understand much about this space, then using CeFi exchanges will make a lot of sense because a lot of heavy lifting is done by the exchange itself. Number 2 is the argument around ease of usage. For example, centralized protocols like Vauld are very smooth, easy to use. The UI UX interface is very convenient. So the ease of usage argument is another key reason to be using CeFi protocols. Then comes the argument of time, that if you are pressed on time, if you have a day job, you can't track your day-to-day yield and you can't stay on top of things, then again, going to a CeFi protocol will make a lot of sense. An important point to note is that this entire process of scouting for the best possible yield is called as yield farming. So that is the basic introduction on yield farming. I'll make a slightly more advanced video on that. But this entire process of yield farming comes with a series of risks. Yes, it is true that if you are going to a DeFi protocol, the chances of making yield goes up. But accordingly, the risk also goes up. So before closing out the video, let me speak about some of the salient risks involved in the entire DeFi ecosystem and more prominently around the concept of yield farming, liquidity pooling and staking. So there are 4 key risks that exist in these DeFi ecosystems. The first key risk is called as the rug pull risk. So rug pull simply means that many a times a new coin will be launched. A lot of hype might be created and you might get lured to invest in that particular coin. So you might stake your money in that particular coin and then developers will leave that ecosystem and that project will not even get kickstarted. So that process is called as rug pulling, that developers have left that protocol and your money has been taken away. So that's a very risky thing. It happens quite frequently in the crypto world. Also, it is very important to note down that in the crypto ecosystem, there is a lot of decentralization. So decentralization simply means, or one aspect of decentralization is that people can come, create their own coins and get others to invest in it. This process of launching your own coins or launching your NFT, it's super easy. Anyone can do it. And it is actually a disadvantage and an advantage of the crypto ecosystem. What you and I as investors need to remember is that before investing our money in any of these new coins, we need to do a thorough analysis. At least go look at the Discord server, look at the Telegram group, look at Twitter. What are they posting? What is the utility of the coin? Read the white paper. These are basic things. If you just simply go through it, you will be able to avoid at least 99% of these rug pull scams. The second key risk in the DeFi ecosystem is the regulatory risk. A lot of this is unregulated right now. So governments keep on coming up with new laws and regulatory frameworks. So anytime a new law or a new framework comes into the system, it can impact the coins that you are staking. So this becomes a second risk. Third risk is the volatility risk, that given that the crypto market is very volatile because it's a fairly newer asset class, the volatility can go up and down quite aggressively. So that is another risk that you need to keep in mind. And therefore, if you are staking your coins on your own and you are trying to become a yield farmer on your own, you need to stay on top of things. If you can't do it, then do it via CeFi platforms. Those would be more advantageous. Fourth and final risk is the smart contract risk itself, that many a time smart contracts itself can get hacked. Does it happen often? On bad protocols, yes, it happens quite often. But on good protocols, this hacking does not happen because they ensure safety. For example, something like Bitcoin has not been hacked. Yes, Bitcoin exchanges have been hacked, but Bitcoin as a blockchain network has not been hacked. So in summary, the message is very clear. So first and foremost, yield farming, liquidity pooling, staking, these are all innovative concepts in the DeFi world. These are evolving. Please learn about it. It's a fascinating space. There is great opportunity to make money, but that opportunity comes with its own set of risks. So please study the protocol and please do your own due diligence before you start investing in it. It is very important to stay on top of things and follow the basic investment principles like identifying the utility of the coins before investing and staying a little bit diversified. So I hope you enjoyed the video and I will see you the next time.